You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. This week on The Biz, our monthly update series for October 2012. And on today's show, our insurance industry update with special guest Eric Palmer, National Director of Marketing.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, our industry expert and, I must say, marketing extraordinaire on the internet, Eric Palmer. And Eric, just a little kudos to Eric. Remember, Brokers Alliance, our production has been huge in the worst backdrop of the worst economy we've ever experienced in both our modern generations. And Eric and our good boss, kudos to David, have really taken our place to a whole new level because they know how to play in the internet marketing game. And when you think about it, in 2007, not to be a real commercial for us, but in 2007, we were around $6 million. Last year, we paid for almost $30 million a target. That's a move up the line. And I want you to understand that when we're looking at certain things in the industry, we see trends. Now, we have trends today to talk about. Real big trends.
Right, absolutely. Well, I think one of the first trends to talk about is happening a little bit on the annuity side, but it's also happening on the life insurance side. And really, it's a movement towards being more analytical and getting back to some mathematics, the core of mathematics. We've taken for granted, I think, some product features that are out there today, such as lifetime income riders, and really started to rely on them. But the reality is, when you start getting into competitive mode and looking at the actual numbers, one of the things that we didn't get a chance to even touch on in the annuity show, but not just going into these sales thinking lifetime income rider or long-term deferral, but looking at, is there a better accumulation product out there that maybe we're going to put our clients into now, because once they're ready for income, the immediate income or the SPIA rates could potentially be better, or the annuitization options could be better and provide several $1,000s more of income. So instead of just analyzing things based on an income rider or spreadsheeting products, there's a little bit of a movement, and it's something that we're doing here at Brokers Alliance heavily, to be analytical, look at the math, and start making some smart choices. Sagicor, a company that not a lot of advisors know about, but they're a decent company. They're rated A-. We've done a lot of work with them the last several years. They've got a 9-year index annuity with a 4% point-to-point cap. It has a 50% cumulative withdrawal, so great liquidity, and a 2% guarantee. You're guaranteed 128% of original principal no matter what happens with the index at the end of a 9-year surrender. And that's huge. So, that's a product. If I'm talking to a 55-year-old, I might be thinking about putting them into a 9-year index annuity that provides a little bit more flexibility and some opportunity for growth. And then I'm going to reevaluate in 9 years when my client's ready for income, whether or not an immediate annuity and annuitization on that particular product, or maybe there's something better 9 years from now for our clients because hopefully the interest rate environment improves over the next 9 years and we recover some of the rate of return that we could provide a client. So the trend, the movement really begins with analytics, and I think that we're going to see more and more of that over the next several months and the next couple of years.
Well, you bring up the painful point of today's show, which is interest rates still low.
Right.
How low can they go? Well, if you had watched the show on Eric and I last year, I said, it can't get any worse than this, and it did.
Right.
Although I will say this, if you don't have a mortgage under 3.5, you're not shopping the market right now.
Call your broker.
30-year lock is just unbelievable. But what's causing more issues? Our new reg, AG 38, because of the low interest rate environment, people are having to jump to the new, I hate to say this, it pains me to say this, supposedly the New York actuaries were right.
Right.
Okay, I hate to say it.
Well, and South Carolina was involved too. We got to give them some credit.
Kudos there. Because now we're reserving more, and because of this is changing the market. Give us a little update on AG 38, the reg that's causing so much angst in long-term term insurance and long-term GUL.
Well, I think it's interesting. It's been a heavily debated issue over a little bit longer than a year now. There's been a lot of different sides of it, and really what it boiled down to is the language inside of the actual agreement is giving. It's giving the responsibility to the insurance company to make a decision, and I'll even quote, gives them directions and guidance on how to reserve these guarantees, but it's sort of by prescription nature, so it allows them to use their best judgment, and it allows them to weigh in the payment patterns of the consumer. I think a lot of the argument has been, especially on the people that are sort of against or not so happy about AG 38, is that first of all, with the new products that are out today, a lot of these features are somewhat new features. An income rider that carries long-term care type benefits is something that's somewhat newly crafted for the industry. So weighing in consumer patterns is something that we really don't have a whole lot of historical data to do, and to make best judgment decisions on reserving in a low interest rate environment on features of products that we have no historical data on. I mean, that's a lot to swallow.
Well, I thought the AG 38 was actually going to put us in a position where we were going to force our actuaries and everybody down making these product designers to come to a place where they're going to reserve enough so there's no games in shadow accounts, there's no issues in secondary guarantees.
Right.
But if they're telling me that the definition is so loose and there's guardrails that are wide enough where I can make my own call as the actuary,
right,
I'm always going to make the call that positions my product the best, even though I may not be totally convinced that I have the economic viability behind the scenes to make it happen.
Right, and that's why it's such an interesting debate, because I'm split down the middle myself. I look at it like I just mentioned before, but I also look, we sold a lot of guaranteed universal life, and we sold a lot of secondary guaranteed products. Well, what's the stat? I mean, they've said recently 15 out of so many companies have already repriced their secondary products. The GUL companies, there's carriers getting out of the market entirely. Everybody's repricing. So, it's obvious that we do need some standards in place for our actuaries to design these products.
Sorry, that does not sound like a standard to me. That sounds like, hey, your best judgment. And anytime you give us the best judgment out in our world, we're going to the least resistance, and that means we're going to the top of the premium spreadsheet. We're not going to be sitting there parking money in reserves when they're giving us discretion. This is what I thought. I thought we were going to get something out of this, and it sounds like it was official, and it's a guideline, and it's just a guardrail. It isn't really a true reg. That's what it sounds like to me. When we come back from the break, we'll address the status of retirement, along with some of the planned costs and hidden taxes, and we'll talk a little bit more about AG 38. And don't forget, you should enroll at the IULUniversity.com for the best training, education, and sales support when it comes to life insurance.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Welcome to the Brokers Alliance Workshop. I'm Jessica Lopez, and that's Steve Savant. What are you doing?
I'm sandbagging standard and substandard cases for my producers for the impaired risk season.
Steve means he's holding back hard-to-place cases for submission until November.
But if your client needs coverage now, we'll have it underwritten, have the policy owner pay the quarterly premium, and then we'll resubmit it in November.
If you have cases that have been declined, postponed, or heavily rated, we'll package your case with the right company for the best offer.
So let the sandbagging begin. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And remember, you can order today's giveaway shows, all our articles on thebiz at brokersalliance.com. And just a heads up, before moving forward with any of the ideas we talk about on the show, always consult your tax advisor and broker-dealer compliance officer. And we're talking about the status of retirement, costs, and hidden taxes. But before we get too far, I just want to redux a little bit on AG 38. Let's talk about the rate increases, the benefit decreases, and the exodus. And I'm not talking about the biblical leaving Egypt. I'm talking about the major exodus of carriers leaving our market here on GUL.
Right. Well, I think let's start off talking about rate increases, because a lot of insurance companies have announced, or I should say more insurance companies have announced the rate increases than the exit. I think that's at least something positive to pull out of this. But rate increases are what they are, and we've gotten so used to selling certain companies because they have always been notorious for being the lowest rate. Well, these are the companies that have just increased their numbers. Just
a little side note, when Jessica and I were on our Tuesday show, we were doing the GUL spreadsheet, and it was half the pages it used to be. So somebody's left the market, and not only, I shouldn't just say GUL, but 30-year term market too.
Well, that's a big dump, and we'll talk about that in a second for exiting the market. But other than Pru, who's actually has kept a 30-year term in place, but they've increased the rates. We've got Banner, we have Genworth, making increases on their universal and their term UL products. There's some of these hybrid term UL type products. Genworth had a lot of them. On their 10 and 20 years, they've gone up 5%. Banner's up 9% on their UL premiums. MetLife's up on their UL. Principal, Prudential, Transamerica, United of Omaha. Here's some big name companies that have been the most competitive, especially Banner, especially with
yeah.
the Guaranteed Universal Life, and Genworth with those 10 and 20 years term GULs. They were number one in most categories, and they're having to bring those premiums up. So that tells you, expect the top of the ladder to start to come down. So some of the companies that we maybe saw in 15th place on our spreadsheets, they're naturally going to move up to top 10 because of these companies that were leading the pack having to raise their rates.
Interesting enough, if you want to order our spreadsheets on this, and we have that, just write me, thebiz at brokersalliance.com, and I've already posted our term all the way out to 30-year out on the web. That's out all this month for October. But I want you to really think about this, because if everybody's raising their rates, that means there's a configuration, because really the Banner rates, as an example,
Right.
LGA's rates really only went up a nickel. And I looked at the balance sheet, and when we reconfigured the market, it wasn't that big a position move.
Right.
So it was kind of like, okay, we took our hit, and that was it.
Right.
Now, but I've noticed also a difference. Rates stay the same, but the benefits are dropping. What's with that?
And we're talking about rates, we mean premiums, right?
Yeah.
But the crediting rates to the policies, the majority of them are being decreased. So you've got MetLife, New York Life, Protective. I think Hancock just did some moves on their no lapse, and Lincoln on some of the stuff with their VUL and their fixed rate buckets, but they're bringing those crediting interest rates down. So our premiums are going up. Our interest rates we were talking about north of 5 even 14, 15 months ago. We're happy if we're north of 4 in a guaranteed universal life insurance contract. So again, we're talking about 30-year, issuing at 2.7-ish right now. It's hard to sustain a long-term portfolio rate north of 4%. So we're seeing that stuff come down, and some big name companies are making those types of benefit decreases. Most of the benefits we're seeing that are reduced have to do with that current rate.
And just remember, on our show, Jessica and I were talking about a case where that case was actually won only because one of the companies shortened their benefit period, right? The other company didn't. The difference in premium was nothing. It was just a battle of who stayed online contractually the longest.
Right.
This is where you're going to see battle lines drawn, especially with super preferred, preferred plus, and preferred. People are going to say, since I'm going to be living longer, who's going to hold out for the guarantees the longest?
Right.
And that case, which normally would not have been won by the carrier we're talking about, actually was won by them simply because of that issue.
Well, it goes back to what I said at the beginning, is we're becoming more analytical at the way we're choosing products. So if I run a spreadsheet on Guaranteed Universal Life, I'm going to look at the top 5, top 10 companies, and I'm going to look at them from a couple different perspectives now. It's not just about premium. I want to know what their current rates are, and I want to know, have they made any moves recently? Because technically, moves like this are responsible. They're making adjustments to be responsible for their policyholders in most situations. Right. I don't want to say everybody's doing the right thing and make a blanket statement like that, but if I look at responses to a low interest rate environment and they're making changes that are tough to do, but you got to make them, then I'm going to look at those companies as being companies that might be a little bit more sound long-term for my clients. They're going to try to manage their portfolio so that it's still a benefit to the client. And so we've got to take those things, we've got to analyze those things now. It's not just about who's got the lowest premium on a GUL anymore.
Well, when I was looking at the ALIRT update on all this, I noticed, of course, we all knew Sun Life left a long time ago.
Right.
They're one of the first people out the door. Hartford looks like they took off, and AXA actually did a little bit. It exited only the SGUL market, right? Because I think that's the only thing they were into. But we had Genworth, ING. There's been a lot of reconfiguration on the late term area. So 30-year term, and there's only a few players. And you said Prudential still is in that hunt, and that's why they're going to be playing. And by the way, it could be an impaired risk land, especially if you have clients that are going to go 30-year term. These guys got monster retention. So when we get into our Halloween show coming up in about 3 weeks, Eric, we're going to be talking about players and pretenders. Now let's talk a little bit about, we're going to shift gears because I always want to talk about this because people are really getting traction about expense loads on 401ks. We've been talking about this. We want to just give a heads up before we close the show. Again, the new reg 408B2, full disclosure on 401ks. Thank God for the first time we actually know what's going on.
Right.
We're comparing those expenses against our expenses of a non-qualified death benefit, fully suppressed life insurance contract, and I'm telling you, we are winning the minds of people who have been not really happy with us in the past.
Well, I'd say don't just take our word for it. If you go to Brokers Alliance website, you'll notice there's a banner on there. We have a little program called IFL. We've built some calculators. The calculators do the math for you. So get into this, use these calculators, because your clients are going to look at this and they're going to understand that, I might need to put a little bit of money into life insurance here, and it's going to help them make that decision.
It's all in, we're showing the measurement, and now you can have it yourself. Remember, you can watch this show and all our shows by clicking the red on-demand video button right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. Get in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.